This week on WealthTrack, why is great investor Stephen Romick hoarding mounds of cash and other safe money-type securities in his award-winning FPA Crescent Fund? Contrarian Romick explains why he isn't putting his cash to work in the market. Next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fair Home Foundation. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. Holding cash is considered by most professional investors to be one of the worst investment choices you can make right now. It yields next to nothing, as it has for the last 5 years, largely because of Federal Reserve and other central bank policies that have kept short-term interest rates at record lows. And when inflation is taken into account, cash is actually a money-losing proposition. There is, however, a small minority of investors who value cash and are not afraid to hold large amounts of it and its equivalents when conditions warrant. Warren Buffett is probably the most famous among them. This week's great investor guest is also one. He is Stephen Romick, lead portfolio manager of the 5-star rated FPA Crescent Fund, which he launched more than 20 years ago. Romick and his team were named Morningstar's Allocation Fund Manager of the Year in 2013 because of their, quote, capital preservation and strong stewardship, which helped the fund achieve its goal of delivering equity-like returns with less equity risk over the long haul. Since its inception, this Go Anywhere Invest in Anything fund has delivered better than 11% annualized returns, besting the stock market and its balanced portfolio benchmarks by substantial margins. Romick, a proud, self-professed contrarian value investor, has been a vocal critic of the Federal Reserve's unprecedented monetary expansion and has become increasingly wary of the rich levels of prices in markets around the world. In quarterly letters to clients, he has pointed out several indicators of just how expensive markets have become. One of the most dramatic is this chart sent to clients in his last annual letter, showing stock prices as a percent of GDP. As you can see, the value of stocks was worth more than 200% of the economy's total output of goods and services, rivaling the market peaks of the dot-com bubble. As the markets have appreciated in recent years, Romick has been reducing his stock and bond exposure and raising his cash positions to the second highest point in the FPA Crescent Fund's history. I asked him why.
We're not that optimistic. It's not that we're pessimistic. I don't want to confuse the two. It just, we are, it's not a target-rich environment. Multiples, in the market are higher than average, and there's real risk out there from central bank action. How it all ends, we don't know. We don't know with all the trillions of dollars that have been used in some type of academic arguments, with the hopes that it alchemizes into reality, is yet to be seen. So we don't know if we're going to have inflation. If so, how much, when? We don't know if we're going to have deflation. If so, when that might occur. And so we have a portfolio today that's kind of betwixt and between. We're trying to create it in such a way that it's robust to more than one scenario, because we have the ability to do more than most. One might say we have more than one way to lose money because of that, but nevertheless, we like to look at it as opportunistically as we can and say we can buy common stocks, preferred stocks, junior debt, senior debt. We can buy container ships. We can invest in different parts of the world, and it gives us a lot of opportunity to look at different kinds of things. And we look across the world today, where we have zero interest rate policy in so many of these developed economies. It tends to pervert capital allocation decisions. And as a result, asset prices get lifted, and we find less opportunity than we have historically found. So at the end of the day, price is going to be our guide. And so you could have a terrible outlook, but as long as the assets you're considering purchasing have that bad outlook priced into them, then that's fine. So the problem we have today is we have concern about the future for some of the reasons I mentioned, and yet the assets aren't really taking that into account. So the risk reward for individual investments on a micro basis are not terribly attractive. So cash builds for us as a byproduct of what it is that we do, not as a top-down view, oh, the world's expensive, so let's go have a lot of cash. One thing I'm confident of is that there will be greater volatility in the future than there has been, most recently.
Right, because we've had very low volatility historically. Why do you think there's going to be more volatility?
Well, there's never been a point in time in history where governments have been able to really get together and say, hey, let's go and manage the economy by doing all of these things. We've got, a $4 trillion, Fed balance sheet that has to contract at some point in time.
So we're seeing a gradual pullback, at least in this country. So, and yet volatility has not increased. So is it possible that we could have, kind of a soft landing of the withdrawal of central bank easing, that's a possibility?
Everything's possible.
Yeah.
I mean, Kermit the Frog married Miss Piggy. Nobody thought that would happen. So yeah, anything could happen. So I think that, although I think it's unlikely, I think that, we're challenged by the idea that the government can really manage this in such a way. And you spoke to, contraction and quantitative easing. We haven't had any great effect yet. However, it's really a three-part process because we built up the balance sheet. So now what we have to do is they're going to start by reducing asset purchases.
Right.
Then second, they will stop asset purchases. And then third, they're going to have to find somebody else to refi out the balance sheet as the balance sheet, unwinds as those loans that they've purchased or whatever it is they purchased, come due. So there's a lot that still is yet to come. And we know what's quantitative easing is something none of us even heard of a decade ago. We never thought about. And now we're looking at this and saying, now we're depending on it. It's a little bit like we're addicts. I mean, my partner, Bob Rodriguez, calls it Red Bull economics. You get all jacked up on the Red Bull and anything can happen.
How are you managing your cash now versus what you would have done traditionally?
Well, in the past, we were more commercial paper with a little bit of U.S. Treasuries. And then as we got into 2008, we started backing away from Treasury securities.
Okay.
And we really focused more on U.S. Treasuries. Just because we weren't getting paid to play, we weren't getting paid to assume the risk. There are too many questions out there. And we questioned the Treasury function in some of these companies. We didn't have to, it wasn't an analysis we wanted to make at the end of the day. We wanted to go and analyze businesses and know that we're buying those businesses or assets at good discounts to what the underlying value was, to give us that, the margin of safety, if you will. And we didn't have to make that analysis in the case of commercial paper. So it was a why bother, not getting paid for an equity rate of return, so let's just not worry about it. So we owned U.S. Treasury. So since then, we have less of that concern. So commercial paper has come back into the portfolio. And we've also gone overseas and into certain other,
Some sovereign debt, right?
Some sovereign debt, where we've actually hedged out some of the currency risk, but we still have the sovereign risk, but we've actually been able to, in the one case we've really done it in any kind of size, been able to actually get higher rates of return than we could, even after hedging out the U.S. dollar.
Which is in Australia?
Singapore.
Or Singapore.
Yeah, nearby.
Yep. So why are U.S. Treasuries no longer the most prudent course?
Well, for us, it's just a question of we think that there's other places you can do just diversify away from to protect your capital. I mean, the U.S. Treasury market, we didn't think anything was likely to happen, but in this case, diversity is a good thing.
And you're a contrarian investor, and you're very proud of that fact. So, are there any contrarian investments out there now that are catching your eye? Where else is there to go but cash?
There have been a few places we've been finding to invest. The problem has been the reason why cash is built. There hasn't been enough to create a whole fully invested portfolio. So in the last 6-9 months, we built a position in the aluminum industry. The aluminum is trading at a historic low, inflation-adjusted low, particularly since such a large percentage of the cost of aluminum production or energy, and energy costs are a lot higher today than they were a decade ago.
So I know Alcoa, for instance, is one of the holdings.
Alcoa, Norsk Hydro, and Alcoa is an interesting one because Alcoa, everybody who follows Alcoa, the Wall Street analysts, are metals and mining analysts. And what tended to get lost in looking at Alcoa was that the largest portion of its value was not the stinky, smelly, polluting aluminum business, but was the engineered product solutions business, where they are really one of only 2 people in the world that manufacture these as aerospace suppliers, with these highly engineered products that really don't use much aluminum at all. I mean, more than 90% of it are specialty alloys and titanium. So Alcoa, it's an aluminum company, has its most valuable division, does very little in aluminum. And people weren't valuing that correctly because the wrong people were looking at it.
Right.
And so that gave us an opportunity to invest in Alcoa back last fall. And we were able to, what we viewed at the time, given the terrific value for the engineered product solutions business, whose largest competitor is Precision Castparts. If you had applied, Precision Castparts at the time was trading at 14 times EBITDA, and we weren't going to apply multiples like that to this business, even though we would argue it was as good, or is as good, as Precision Castparts business. Even at a discounted value, we had a huge option on the turn in aluminum, and we didn't know when aluminum would turn, or we don't know will it turn, but we do know that half of the capacity in the world is losing money. So only half of aluminum in the world actually makes money today. So you either need to see supply contract, which is happening. Alcoa is closing smelting capacity today as well, or you need to see terrific demand growth, and we are seeing demand growth as well. If you look at the backlog for airplanes, for example, it's an 8-year backlog, about as high as it's ever been. And they're big users of aluminum for skinning and everything, and other parts of the airplane, as well as you see it beginning to really at the margin move in the automotive industry. So you can think of examples in GM or Ford where you're seeing increasing amounts of aluminum used, and they're putting 300 pounds more of aluminum in a Ford F-150, which will save 1,000 pounds of steel, which makes these cars lighter, easier to handle, and also give these cars better, more apt to meet EPA requirements.
How does Alcoa aluminum get on FPA Crescent's screen?
We can thank Brandon Stranzel for Alcoa specifically, who's on our team.
One of your research analysts?
One of our research analysts. And the way he got to it, it's, look, we're in the business of looking for bad news in very simple terms. So whenever you see stocks that are at making new lows, or you see headlines that say, well, aluminum is dead, aluminum pollutes, the aluminum capacity closing, Alcoa in trouble, Norsk Hydro in trouble, Rusal in trouble. You see those kinds of headlines, we get attracted to say, there's lots of bad news. There's probably natural sellers. So maybe we can go and take advantage of that. One of the things that we bring to the table, we believe anyway, is that is time arbitrage. We're very patient as investors. We patiently wait for the opportunities that we've patiently researched, and we patiently wait for those opportunities to work out. So the bad news today is not unrealistic. It's fair. The aluminum business is challenged today. However, we're comfortable looking out a number of years that it won't be as challenged in the future. And so if we're patient and we can wait for that opportunity or the valuation to reset down the road, and as long as we can get what we feel is a good IRR between now and then, we'll look to go and invest in those kinds of businesses.
So do you tiptoe in? Do you gradually build positions? Or it just depends? Yeah.
Sometimes we have to get to know the business better over time. It takes time to get to know these businesses. Sometimes we have a very strong understanding at the get-go, or we've invested in that business before. And at the end of the day, it's a combination of understanding and price. Understanding, conviction, and price, I should say.
Looking around the world, where else is everyone running from?
I don't know they're running from a lot of places. There's not a whole swath of businesses that are out of favor.
Well, they're running from the emerging markets, for instance. And
right, but emerging markets, interestingly.
Russia.
Emerging markets in general are areas that, the multiples have contracted a bit, and stock markets have declined in emerging markets. However, more of that decline has really been the result of commodity-based companies, more cyclical companies, and finance companies. And these are businesses that we aren't as interested in many of these markets.
Because they're just too cyclical?
We prefer, on average, to own a higher quality business.
Yeah.
And in the case of Alcoa, the aluminum smelting business wouldn't be as high a quality. The EPS business, that engineered product solutions business, is of a very, very high quality. So we want to own these higher quality businesses. And the higher quality businesses in emerging markets aren't trading at big discounts. But you mentioned Russia, and we have a small stake in Russia. Russia is interesting because you have, it's obviously quite combustible over there right now. And it's unusual because you have a chance to, a lot of people are running in fear. And when looking at Russia, you can look at a lot of companies that are actually of strategic importance to the state, as well as to the globe. So, something you couldn't say about Venezuela, for example. There might be businesses that are important to the state, but not as important to other countries around the world.
So they've got these giant energy producers, for
instance.
Exactly.
They're the largest. Russia's the largest hydrocarbon producer in the world.
Right.
And as far as public companies are concerned, they have the largest reserves in oil in Rosneft, and the largest reserves, as you mentioned, in Gazprom, and in gas. And it's of strategic importance to the state because energy accounts for 25% of Russian GDP. It's 50% in Russia of their annual revenues, And representing its strategic importance to the state and how important it is to their neighbors, it accounts for 60% of their exports. So we understand that there's risk there. However, these companies are trading at very large discounts to other companies of their ilk, an Exxon, for example. So these large discounts, justify the risk of owning some of these companies in Russia, which has an uncertain future. Well, not that Russia's future is so uncertain, but over the long term, but shorter term, there's clearly, some questions, but that's what created, again, these natural sellers, which allows us to come in and do some buying. But what's interesting about, looking at Russia is that the people there seem to be less concerned. There's massive insider buying in some of these companies. In the last 12 months in Lukoil, for example, there's been $1 billion purchased. Now, one might, from insiders, one may question where they got $1 billion. But when you look at these Russian companies, there's a fair amount of taxation goes on by the Russian government, and there's probably another, call it, less official means of taxation in the form of, more nefarious activities occurring within the companies. However, the earnings we see, are audited by legitimate companies, and these earnings that we're seeing today are already net of both forms of taxation. So, and they're cheap on that basis. As long as things don't get worse in that regard, we can be pretty comfortable, with these companies that we're buying them for at these prices today.
So it really is because of the prices, because it would make me nervous as an investor to know that you are in a thugocracy, as someone told me, that what Putin is running Russia, and that, heads of companies get thrown in jail at any given moment if they get too powerful. So isn't that, for somebody who's most concerned about avoiding the permanent loss of capital, and you always say that your defense is more important than your offense,
Well, there's no argument that this is a complex, complex country with an authoritarian regime. There's no argument there. However, again, we feel that price is the guide, and we argue we do play defense first.
Right.
We think about it in terms of the whole portfolio. So it's a defensive portfolio. If you're not willing to lose a little money along the way in certain investments, you're not going to make money either. So there's no chance you're going to go through life and not lose money. So if you size positions correctly, and we believe that our investments in Russia are sized appropriately, not to say they won't increase somewhat, but it's never going to be the largest part of our portfolio, for sure, for some of the reasons you mentioned. But we certainly are willing to accept some risk attached to that. And don't forget, you can't steal from something that's insolvent. The country needs these companies to continue to spew off cash. Again, 25% of GDP, 50% of Russian government revenues. So you need these companies to continue to throw off cash flow to fund whatever the regime wants to do.
One of the things that you and I have talked about in the past is that you look for companies that you call compounders. And these are companies that you're definitely going to make money. The question is not if you're going to make money, but it's how much money you're going to make. And in 5 to 10 years, they'll be worth a lot more than they were worth today. So what are your favorite compounders in the FPA Crescent portfolio right now?
Well, one example of a compounder would be a company called Meggitt PLC. Meggitt is an aerospace supplier, and we actually like the aerospace industry. You'll have growth in passenger traffic, 3 to 6% over the next 10, 20 years. That's a nice place to start from, and that's the reason that airline traffic is going to increase around the globe for a number of reasons, not the least of which is growth in emerging markets, growth in population, as well as growth in increase in wealth. More people will fly, more airports are built, and it all feeds upon itself, and you're going to see a lot of that over the next 10, 20 years. So to find a company like a Meggitt, which is dominant in the wheel and brake business, and they have a number of other businesses, but the biggest portion of their profits comes from wheels and brakes, and they have more than 50% share in the regional jet market as well as the business jet market, where in those two markets they're single sourced. So a company, an OE, an original equipment manufacturer, will go and contract with a Meggitt or somebody else, and hopefully Meggitt in our case, since we own Meggitt, will contract with a Meggitt, and Meggitt doesn't, basically gives them the wheels and brakes for free, because they make all their money in the aftermarket, and there's huge margins on that. And these products get priced as the wheels wear out, and parts break, and they get priced in this over time, ahead of inflation. So it ends up being a terrific thing. You have terrific confidence that you can get a vision for what the earnings will look like in the future. Again, to your earlier point, as we think about compounders, we can't know exactly what they are, but this is a company that we felt was going to grow at a very healthy clip, that just generate a lot of free cash flow. We hope that management makes intelligent acquisitions, uses of that capital, which there's no guarantee of that, and that's the, if I had to go put a risk out there for on Meggitt, it would be, how they spend their capital, because they're an acquisitive company. They've done a reasonably good job historically, but the fact is the returns on capital for their core organization, for the business X, the goodwill are very, very, very high. And that's what we want them to focus on when buy shares back intelligently when they, as prices permit. So as we think into the future, as we look into Meggitt, we think that this is 5 to 10 years from now, we believe the business is going to be a better business than it is today. And as long as the multiples at least maintain, we'll do very well. And given the fact we bought a company at a discount to the market, then there is some optionality in the multiple. That's not something we're counting on.
We always ask all of our guests at the end of the interview is if there were one investment we should all make in a long-term diversified portfolio and you can never recommend your own fund, what would it be?
It's interesting today. I actually see there's being more opportunities in the private sector than there are in public. I mean, where there's more inefficiency, relatively speaking, is in the private sector, which is why in our fund we also invest in certain illiquids, and we're able to make certain real estate loans and get low teens
real
IRRs.
estate loans. So
First lien real estate loans. We partner with a AAA real estate investor to make first lien real estate loans, and we're getting low teens IRRs, expected IRRs I should say, on these loans, and we're very excited about it given the good loan to values that we have. And I think that for an individual investor, I think that at this point in time, one needs to be wary.
One of the things that you and I had talked about the last time you were on was you were also investing in farmland, in private partnerships that invested in farmland. So they're illiquid, they're long-term investments. They're very small part of your FPA Crescent portfolio, but that's the kind of things that you are having to get involved in because there are so few other opportunities out there.
Yes, but I would also say it's more than that, because in the case of farmland, which we first invested in a few years ago, and it's not as inexpensive as it was.
Right, it's definitely appreciated.
So it certainly has worked. It's not just a question of because so few opportunities elsewhere, but we like the way that investment would behave in a number of different scenarios, not the least of which would be inflation, decline in fiat currencies. So we felt it made sense within the portfolio, but it wasn't just because we couldn't find investments elsewhere. Same thing with the real estate loans. I wouldn't say that we wouldn't own these real estate loans in a different environment where there was more opportunity, because we very well might, depending upon what was available elsewhere. Because these real estate loans, our goal is to provide equity rates of return to our clients.
Right. And
to do so and avoid a permanent capital along the way. And if you can go and get low teens IRRs, as we think we're getting on these real estate loans, then why not? And we'll take that all day long. And it's not going to have the same kind of volatility as other investments might. We won't get the same mark-to-market risk, in the portfolio day to day. And we can just clip coupons for a few years.
And last question, what would get you more interested in investing some of your cash?
Again, it's bottoms up. And we talked about a couple of themes. Aluminum was one. Russia was an example that you brought up. And so it could be thematically driven, where we see areas of the world or asset classes or industry groups that fall out of favor, or individual companies, having a little stumble along the way.
Stephen Romick, it's always a pleasure to have you here on WealthTrack. So thanks very much for joining us.
Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point: keep a stash of cash in your portfolio. Cash has become a dirty word in most investment circles because it yields close to nothing right now, but it has other redeeming virtues that make it a must-have asset. Cash adds ballast to a portfolio in choppy markets. While other investments rise and fall, it provides stability and protection. It adds liquidity and opportunity. Cash may be put to use at a moment's notice, especially to buy when others are selling. And it provides a psychological advantage. Fair Home Fund's Bruce Berkowitz calls cash financial Valium. It keeps him calm when others are panicking. Next week is the start of one of public television's fundraising drives, so WealthTrack might be preempted in some markets. We are therefore revisiting an interview with another great investor and Morningstar Fund Manager of the Year. The Royce Fund's Charlie Dreyfus will explain why a small cap manager is also investing in large cap stocks. Please go to our website to hear our extra interview with Steve and Romick. Also visit our new WealthTrack Women section. We will have updated financial advice specifically for women from our panel of award-winning women financial advisors. In the meantime, as you enjoy your Memorial Day holiday, take a moment to remember all of the soldiers who sacrificed throughout our country's history to make our precious freedoms possible. We owe them our undying gratitude. Have a lovely weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fair Home Foundation.